feeling well. I've got a flu. So I request that I be allowed to switch off my video if members um, feel comfortable with that. I'm not feeling well today. I've got a serious flu. Thank you. Our members, the leadership of the Land Bank and Agricultural Development Bank. Ladies and gentlemen, allow me to greet you in the name of our Lord Jesus Christ. Amen. Today we are going to get a briefing from the Land Development Bank, and also, as I look at the chart here, platform, I see Mr. Jabu, who's the acting CEO, and also Mr. Sanji, who will be able to lead the delegation of the development bank, Agricultural Development Bank. So, good morning to all the members on the platform, the officials from the committee, and the leadership of the Land and Agricultural Development Bank, led by Mr. Jabu Mpambo and Mr. Cindy Samji. I know Mr. Jambu is the acting CEO, as I'm told. The committee today has convened our members to receive a briefing from the Land Bank on the financial performance, funding model, and overall financial system sustainability. And we look forward to the constructive engagement and our members. And let me take now this opportunity to request the secretary to the committee, Mr. Ndatemangweni, to take us to the next item, being the apologies, before we get over to the London Agricultural Development Bank. I also want to request SLB, as I indicated earlier, that I'm not feeling well. I'm going to request Ms. Lekwase, who's the chairperson of appropriation, to also assist me after the presentation by the Land Bank.
Morning, Chair. Morning, honorable members and the delegation from Land Bank. From the side of members, Chair, we do not have an apology. The only apology I got was from Deputy Minister Saropeng. He will not be joining us today. Thanks a lot, Chair.
Okay. No, thanks very much. Let me now hand over to Mr. Sanji. I'm not sure who's going to start, whether it's the acting CEO or it's Mr. Sydney Soundi. They will all guide us. I'm now handing over to the Land and Agricultural Development Bank.
Good morning, Honorable Chair and honorable members, and thank you for the opportunity to update you on the bank's funding model, our views on the financial sustainability of the bank, as well as policy issues that we believe the committee should be aware of and hopefully play an active role to help us resolve some of those. I'm switching on my camera so you can see me as I do the introductions. I'll be presenting the presentation that we have today. I have some of my colleagues on the line. We're joined by the Chief Financial Officer, Ms. Kansanen Mkari. Also joining us is Mr. Sydney Soundi, who is the Chief Strategy Officer. And also we have the Executive Manager for Treasury, Acting Executive Manager for Treasury, Ms. Priscilla Jezi, who is joining us. Given the focus of the discussion will very much heavily be on the funding update, we thought it's appropriate that she also be in the meeting. I will be sharing my presentation, if that's okay. I don't know if you have it that side, or I can share on my side. I'll try share. Let me see. Okay. Please let me know if you can see it.
Yes, we can see it, Mr. Pambo.
Okay. Apologies. Let me try again. All right. Can you still see the presentation?
Yes, we can see it.
All right. Thank you so much. So the focus of the update today will look at three areas. One is to provide an update on the bank's funding model. Two is to reflect on the financial sustainability of the bank. And then lastly is to discuss some legislative or policy issues that are important for the committee to be aware of. Just as a start, to give you some background, as we know, the core business of Land Bank is to provide financing to the agricultural sector with a mandate for food security and transformation. And we are governed by the Land Bank. So as a DFI, we seek to develop and transform the sector. For the past few years, the bank has been funded from the debt capital markets. And as we go through the presentation, you will note some of the challenges that reliance has brought to the bank. Of course, you'll be aware that in 2020, the bank unfortunately went through a debt default. And as a result, we had to liquidate a significant portion of our performing loan book that we had lent out to clients, to release cash so we can settle majority of the debt that was outstanding on our side. And we have managed to reduce that debt by over 83%. And currently, we're only left with a small portion still to be repaid. Also important to note is the fundamental challenges that the bank has gone through, some of which led to the default in 2020, relate to the funding model itself, or the capital structure of the bank. At the time, the bank had a weak balance sheet, given that majority of its financing, over 95% if I recall, was coming from the debt capital market, with little equity or reserves in place. Linked to that is also the issue of high cost of funding, which of course impedes the ability of the bank to properly play its role as a developmental institution. So the issue of high cost of funding is one that needs to be resolved, and we have some initiatives we are working on to assist in solving that issue. And third is the funding model reflects a mismatch of assets and liabilities. And by that, we're talking about how the bank is funded. We received that funding from debt capital markets that had short tenure. So we had to repay those debts in a short space of time, whereas the loans that we're giving to clients get repaid in a far longer space of time. So that mismatch creates a problem in terms of financial sustainability. It's one of the structural issues that the bank is busy working on resolving, and we'll get to the details later on. Of course, the debt default was cured in September 2024, which then enabled Land Bank to resume its lending activities and support the sector, including historically disadvantaged persons, specifically emerging farmers. As a result of that debt queue, we had to agree to a liability solution with our current debt funders, commercial banks, it's quite a long list of funders that are part of this liability solution to ensure that the bank can restart its lending activities. We have, since September 2024, been on a debt cure status, and as you know, we've been operating as expected, supporting the sector since then. Following that default, the National Treasury or government had to intervene to assist the bank to get out of the default. Part of that required a capital injection, which is about 10 billion rands, and was drawn down over a period of time to ensure that we can cure the default and also resume lending activities to support the bank. We thought before we go into the details, it would be useful just to share the evolution of the funding model of the bank. And apologies, the colors may not be too helpful because in some graphs they reflect different things. But if you look at the green boxes at the top left corners, you'll see that in the apartheid times, Land Bank was largely supported by government to fulfill its developmental mandate. Reflecting in 1977, over 87% of its funding came from government. There was some debt that the bank secured from the debt capital market, but given that there was this consistent support, what it did is it enabled the bank to support the sector. And as you know, in apartheid times, support was given to white farmers. So the government of the time was very intentional to support white farmers by providing access to finance at cheap rates. And those cheap rates could be achieved because the government was injecting consistent support into the land bank. A number of the large agribusinesses that we see to date actually came through the land bank. Most of them, of course, are owned by white farmers, and it was as a result of that support that was provided by the government to the land bank at the time, which enabled cheaper access to funding for farmers of the time. Of course, things changed post democracy. I believe it was around 1999 or so when government started or stopped supporting the bank with annual allocations. And as a result, the funding model of the bank changed, placing more reliance on debt capital markets. So what that means is, as a bank, we have to go to other banks, international banks, or development finance institutions that have big and strong balance sheets to borrow money from them that we can then lend on to our clients. Of course, because we borrow from the debt capital markets, those costs are not cheap, and we will not be able to always support farmers with cheap funding if we ourselves are not getting cheap funding. So that becomes a structural problem that the bank has to navigate. Given that the mandate to develop and transform the sector still stays, it's important for the funding model of the bank to also reflect that. It's an unfortunate mismatch if the bank is expected to develop or play a developmental role, and yet it is not funded to be a developmental institution. And that is the challenge the bank has been through in the past couple of years, which unfortunately has also contributed to the problems that it faced in 2020. So that background is just to lay the foundation to reflect where we are currently. And just to reflect again on the debt default, you may recall from public media that before the default, the bank was downgraded by one of the credit institutions and subsequently that led us to a debt default. We had challenges of liquidity at the time. There was dependence on a debt funding that came from the capital market. As I reflected, we had about 95% or so funding that was coming from the debt capital market. So that funding structure reflected a misalignment in the bank's mandate. We had dependency on short-term funding, and yet we were lending out to clients to finance farm acquisitions and land acquisitions, which ordinarily get repaid over a long period of time, 15 to 20 years, 25 years in some instances, and yet the debt that we had to be repaid in a short space of time, which is not ideal. How the bank managed to navigate that was continuous rollovers of the short-term funding that the bank got from the debt capital market. So what that means is whenever, say, a 5-year or 3-year debt became due, the bank would negotiate with its funders to roll it over. That means extend the time instead of repaying it. And that became the operating model of the bank, and it's not sustainable. And unfortunately, when 2020 came and the bank was defaulted, it became very clear that that mismatch was part of the problem. Of course, progress was made in settling majority of that short-term debt. As I indicated, we have repaid a substantial amount of the debt due from as high as 83% in 2009 to 45% in 2020. However, this still remains quite high. And there were some recommendations that came from the Strauss Commission as part of ensuring the bank can be sustainable. Our observations is that, not all those recommendations have been put in place. The bank continued to operate with constrained capital structure. Various attempts to address this structure by the bank have been made, but not yet yielded results. And it's important that we resolve the capital structure of the bank because without that, we will keep going in circles, expecting developmental outcomes, but we're not financing the bank appropriately. And this timeline just gives you a quick snapshot of events that happened pre the default. So you'll see from 2015 to about 2019 or so, there were a couple of external events within the agri sector relating to drought, erratic rainfall, and various diseases that our clients faced. Of course, these have an impact on our performance as a bank. And so they did raise concerns of high NPLs, which were then flagged by Moody's at the time in 2019. Moody's flagged Land Bank for a downgrade, which subsequently materialized in 2020. So the bank was downgraded in 2020. We also had 3 key executives in the business leave during that time. And as part of the debt agreements that we had, there was a clause that indicated that we should not have 3 rolling departures of senior executives in a short space of time within 12 months. Otherwise, that would be cause for one of the lenders to call default, which is what unfortunately happened. So one of the lenders that had a facility of 1.1 billion rands called on the default, and that's how the bank went into default. So what that meant is this funder asked the bank to repay 1.1 billion as a result of breach of that clause, and the bank didn't have sufficient capital to that tune to be able to pay 1.1 billion, and as a result the bank went into default. So that context is very key to appreciate the issue of funding structure and the implication it has on the sustainability of the bank to fulfill its mandate. As I reflected earlier, We have since cured the default in 2024. We entered into a liability solution with our existing funders that requires us to continuously settle the outstanding debt at various intervals and comply with certain covenants and undertakings. Of course, the government intervened as part of curing our debt default through the capital injection that Land Bank received. So you will note from these slides, what we're showing here is a view from 2020 up to forecast period 2031. I think in summary, what the slide is showing you on the top left is the bank was historically heavily geared. The red graph shows you that our funding came mainly from debt that we got from other financial institutions. Because of the default, we had to sell our own loan portfolio, and we had to focus on selling the good portion of that to be able to raise funding to repay our debt. So that red graph starts reducing because we were settling that debt, and part of the increase that came in the green graph is because of the injection that government gave Land Bank to help cure the default at the time. And we are forecasting that as we correct the capital structure of the bank, there should be a good mix of equity as well as debt, instead of fully relying on debt funding to support a developmental mandate. And on the top right graph, you see the loan book also significantly reduced, which is the red graph. And the reason it reduced is because we were selling it to other banks and other financial institutions, so we can raise funding to settle our own liabilities. Of course, the bank is now in a turnaround phase, and part of what we are seeking to do is start rebuilding and growing that loan book. Growing the loan book means we are supporting the sector, we are assisting emerging clients to build and grow their businesses in the sector. So that trajectory is very important, that we should see that loan book growing. On the bottom graph, what you see there is the cash flow position of the bank. What we show is a pre-funding scenario and a post-funding scenario. Currently, we are in a pre-funding scenario, which is the green graph. So you see that in the current financial year, our cash reserves as we go through the financial year will become depleted as we honor our financial obligations to the liability solution lenders, as we continue to disburse more funds to our clients to support their acquisition of farms and production facilities. So that capital will become depleted as we go throughout the year. Hence, it's very important for us to close that gap by raising new funding, and we'll get to that later. Our ability to raise new funding will then show us a graph that looks much better, which is the orange graph, where our liquidity position or cash position starts to look much healthier, and it strengthens our balance sheet to be able to support the sector by providing more funding to our clients. So the key problem statement really on funding and the funding model of the bank reflects a number of issues. One is the asset liability mismatch. As I indicated, this means that currently we borrow money from banks of other funders that come at with a short repayment tenure, and yet we are financing clients who take long to repay us. That mismatch is not appropriate. It needs to be corrected. What we are busy working on is to raise funding that will have long repayment tenures to ensure that we can ideally fund clients for long tenures as well, as we're currently doing. So the asset liability mismatch is one that must be resolved urgently, and we have some work streams on the go to resolve that. The second issue with the funding model is the high cost of funding. And we know in different forums, we've had comments that land bank is expensive, land bank is not competitive. The reason that is because of how we are funded. It's not rocket science. If you go to ABSA and you borrow money from ABSA and they charge you 10%, there is no way you can lend that money at 5% or 8%. It becomes a loss-making business. So how you are funded really speaks to how you yourself can fund your own clients. And that is why we keep saying the developmental mandate of the bank must be appropriately supported. So the high cost of funding is a big issue because it does not speak to our mandate. We need to resolve that. Part of how we are resolving it is the current funding initiatives that are underway, where we are seeking to unlock funding at cheaper cost. But additionally, there is a case to say, if we are serious about development, there must be some sort of consistent balance where the bank can receive some regular allocations to support a certain segment of clients that ordinarily wouldn't qualify for funding at this kind of levels. So it's a structural problem that needs to be solved, and without it being solved, we will keep getting these complaints that land bank is charging clients high interest rates. As I indicated, farmers under apartheid didn't complain about those things because they were funded appropriately, because the funding of land bank reflected the mandate of the bank. Now, unfortunately, that construct has changed, and part of what we are busy doing is to refine it so that we can be able to support emerging farmers at cheaper rates. So it's a very important structural issue. And of course, I spoke about the liquidity shortfall risk, which then necessitates fast tracking of the funding initiatives that are currently underway to ensure that come early next year as well, the bank continues to support the sector. So we have a number of pillars that we are considering as part of the funding work stream. So the first is to ensure that our balance sheet is strengthened and sustainable. A number of things must be in place for that. We have maturity coming up in early 2028, financial year 2028, which is sometime early next year. That means the current debt funders that fund land bank will require us to settle the balance of the debt. We then need to refinance that with cheaper funding. Currently, it's very expensive for the bank to be operating at those levels. We have also been engaging National Treasury around the potential recapitalization. We will be submitting a formal request for this, and this is part of the funding model of the bank. It's not necessarily to say the bank is being bailed out. The bank is being funded to ensure that it can fulfill its mandate. Without this, we'll still have these problems of farmers are paying high costs with the land bank. The source of funding determines how a client gets charged. So for us to really support a strong position for the bank to be developmental, to focus on fulfilling its mandate, that funding mix must be appropriate. And of course, I indicated that part of the funding that we are raising currently is to solve the long tenure issue. So the funders that we are speaking to, we've been very clear that we are looking for funding that will be repaid over a long period of time and not a short period of time. And equally, we need to reduce the cost of funding to ensure that the farmers that we service are do not bear the burden of paying high interest rates. So if we're able to get cheaper rates ourselves, we then are able to pass on those benefits to our funders. And overall, the liquidity of the bank should be improved. The second pillar is on development. The bank's mandate is very clear. We are a developmental institution. We need to transform the sector. We need to develop the sector. It's proven across the world that a developmental mandate will have to have the right funding mixture. Part of what we have seen in the since the launch of the blended finance scheme in partnership with the Department of Agriculture is the effectiveness of that program. We see clients across the country. As you know, we have offices across all 9 provinces. When we engage with some of these clients, they tell us straight, without blended finance, I wouldn't be where I am. It's just impossible. So the role of blended finance cannot be underestimated. And we have seen increased demand for this, which then speaks to potentially the need to increase grants for blended finance. To ensure that the momentum and the demand that we've seen and the impact that blended finance has had continues to be sustained. So development is very important. It will be enabled by ensuring we've got sufficient grants to support the emerging farmer segment with blended finance. Linked to that is our ability to offer concessional funding, meaning cheaper rates for clients, for this segment of clients, because majority of emerging farmers cannot afford to pay exorbitant rates, and that will only be enabled if we have the right funding structure. And of course, we keep the issue of sustainability and climate resistance at the heart of what we are doing to ensure we're a responsible organization as well. And then lastly, it's the pillar that speaks to partnerships. We are working with some partners as part of our fundraising programs to explore how we can unlock more opportunities for our clients, either through support or unlocking affordable financing, etc., etc. And of course, across all these, we've been in conversation with National Treasury as our shareholder, and as I've indicated in a number of forums, we believe the posture of Treasury has been positive. We believe we've got a good working relationship with them. It's really now to make sure we can, see materialization of some of these programs that we have been discussing. And just to refresh our minds on the funding strategy, we have reflected a tiered or segmented approach, if you like, between 2026 and FY 2027. Focus has been on getting accreditation with partnerships, signing MOUs around the funding ecosystem, and then from FY 27 to FY 28, we need to then unlock funding that is appropriate to support our developmental mandate. And then going into FY 29 onwards is really around, using funds from the stabilization and consolidation phase to leverage more funds from private sector as well. So we want to start by raising cheaper funding to ensure that we can immediately support our emerging clients. That will then help us to build a good balance sheet, which can open up opportunities for us into the future to have partnerships with private financiers as well, to broaden the pool of funding that is available for our clients. So as a quick update, I referenced that we are currently in discussions with a number of potential funders. This just gives you a snapshot of some of the funding work streams on the go, what kind of funding we're looking for, the indicative amount, potential pricing, the tenure, where the discussions are in stage. So we've been talking to some of them around unlocking in the region of 18 billion to 20 billion rands, which will be drawn down over a period of time. So it won't come immediately at a go, because we are envisaging growth into the future. We need to make sure that we have sufficient capital to support the sector into the future, and that funding must come with the right tenure. We've been speaking to some of them, reflecting tenures in the region of 15 years, 25 years, 35 years, which becomes appropriate for the kind of work that we do, given we do finance a lot of farm acquisitions, land acquisitions, so that long data tenure becomes important. And of course, the pricing, when you compare it to our current pricing, this will be cheaper compared to what we are currently paying. And this is what we've been talking about when we speak of reducing the cost of funding, to ensure that we can then on-lend to our clients at cheaper rates. So these discussions are at various stages. Some are already at due diligence, meaning that after due diligence, the financier in question will then present their findings to their governance structures for approval, so that we can get access to those funds to ensure we continue with our business. What we are targeting to do this year is to at least raise 7 billion rands immediately, that we can then use to refinance the liability solution expensive funding that we have. And then linked to that is to then unlock 3 billion rands in early next year, which will go directly into funding development and supporting the sector. Then every year for the next 5 years or so, we'll then be drawing down on the approved amount. We, as I indicated, for some of these we are targeting 18 billion rands. So every year from next year would then be drawing down, call in the region of 2 billion, 3 billion, to ensure we can support the sector into the future. This slide just reflects some of the different, call it focus areas, and the types of funding that we are considering as part of our discussions with potential funders. So we are also cognizant to approach funders that will, be looking to green bonds. Typically, those kind of funding instruments would come at cheaper rates if we can demonstrate that we qualify, given our sustainability compliance. And the bank, you may be aware, was enrolled into a sustainability SSCI initiative late last year. We are now commencing work to really bring that on board across the organization. So those kind of initiatives ensure that we qualify for different types of funding instruments, and some of them come at very affordable rate. And all this is to enable the bank to play its developmental mandate by offering affordable funding to our clients. I spoke about this slide. Basically, this shows you post us raising funding, our liquidity position should become stronger and keep growing as the bank continues to originate and support the sector. So this year in particular is very key, because this is the year where we need to raise this funding that I've been talking about and ensure it comes on board for us to be able to support the sector. Just an update on a turnaround progress since the default. You may recall that at the time of default, our debt that we owed to funders was standing in the region of 41 billion rands. That has since been reduced to 6.7 billion rands as we speak. And majority of that was repaid from our own cash, because we had to sell our loan portfolio to raise funding to settle this debt. So it's a significant reduction that we have seen to really reset or rebase the bank into a space where it can continue to play its role. Of course, it was a necessity that the liability solution partners required of us, and of course National Treasury as well. We had to have that partnership approach where the bank had to make alternative means to settle a significant portion of its debt, and then National Treasury contributed through its recapitalization, which only came, I believe, was 2023. A portion of that was given immediately, and then the balance was released post the bank meeting certain conditions to ensure we can continue supporting the sector. That default cure took place in 2024. We have since repaid more than 80% of the debt that we owed. We are now in what we call the consolidation phase. So the turnaround program of the bank is split into 3 phases. Phase 1 is to stabilize the bank. That took place between 2023 and I believe it was 2025. And then the second phase is the stabilization phase, which is from 2026 to 2028. Consolidation phase. Stabilization phase was really around sorting out the debt cure, removing noise in the system and ensuring the bank can restart operating. We are now in the consolidation phase that speaks to increasing efforts to implement key initiatives that will really get the bank to be a sustainable organization going forward. And the third phase, which will come in FY29, is the growth phase. Before the growth phase, we need to sort out the funding issues. We need to reset the bank to be able to support the sector and grow in 2029 and onwards. So where we are now is very critical because it really determines if we are able to grow from 2029 onwards. So that's where we are in terms of the turnaround phase of the bank. The turnaround of the bank is not something that will happen in one go. It's a process that requires us to take measured steps and execute with discipline across a number of areas. Of course, we continued lending to support the agricultural sector with BFS disbursements, and we've seen increased demands. We have seen outperformance on our side as well, given the number of initiatives that have gone into the business in supporting our clients. There are a number of critical enablers to ensure that Land Bank is sustainable, and key of which is resolving the funding issue. And the funding is dependent on our ability to get a sovereign guarantee from National Treasury. We have already submitted that application. This is something that the funders that we are speaking to have indicated they would want to be in place as part of helping us as Land Bank to build on the gains made and ensure we can be strong and financially sustainable. Secondly is recapitalization support, and this speaks to our mandate. And I know it's a debate that keeps coming now and then. Recapitalization is important if we are going to support the lower end of the agricultural sector, because those clients cannot afford certain instruments that others may be able to afford, and so to get them started, they will need that kind of support. A recapitalization enables the bank to be able to offer those services, and it's part of strengthening the balance sheet of the bank to ensure that into the future the bank is self-sustaining and is able to fulfill its mandate. And third is the issue of balance sheet optimization. I spoke about a mixture of debt and equity. Part of the equity is our own reserves. So as we become more and more profitable, we build reserves that we then use to service more clients. So part of that comes from our own profitability. But two, depending on how we want to execute the developmental mandate, there may be a case to say, perhaps consider having recapitalization at different intervals, not to bail out the bank, but to support the sector. Because sometimes those two things get mixed up. A recap does not mean you are bailing out. A recap can mean you are supporting a certain segment in the market that doesn't have the muscle themselves to qualify for certain financial instruments. And so that becomes very, very important. So the mix of our funding is something that will speak to sustainability. And given the mandate of the bank to develop, grant funding for blended finance will become and probably will remain part of the discussion on this. So we would need to also make sure that the grant funding is sufficient to continue blended finance programs. We have seen increased demand, as I reflected. We know the benefits of blended finance. We have feedback from our clients or beneficiaries that have told us, without blended finance, I would not be able to have built what I've built. One client we met in Free State, I think it was Free State, yeah. He now will be having a farm to the tune of 800 hectares. This is someone who started by buying sheep on auction and selling to funeral and different avenues. And through that small scale farming enterprise, started building experience, saving some money. By the time he came for blended finance, we could see there is potential. And that program has enabled him to scale up to the level where now he can have 800 hectares. And we talk about commercializing emerging farmers. That is one of the examples of how this gets done. Blended finance has been that instrument that's played a critical role to get these black farmers to those levels. And of course, we need to restore and continue building market confidence for the bank. We know the bank has been through some difficult periods. The past 3 to 5 years, focus has been to turn around the bank, to regain that confidence. And a lot of work has gone into improving certain processes, certain ways of working. And I'm not here claiming that it's all sorted. We know some of these things take time, but it will also be inaccurate not to reflect the progress that has been made. Progress has been made. There are still areas that we need to improve on, and we are working on them. And that balance is very important to speak to the issue of restoring confidence. And of course, lastly, is access to concessional funding, which I spoke about earlier. So just in conclusion on this segment, initiatives are in progress to raise new funding. Potential funders are being engaged. There are different stages of the fundraising process. We have given ourselves a stretch target to have an approval from funders before the end of this calendar year, because we need to make sure when we start the new financial year, we have strong financial muscle to continue supporting the sector. Suitable funding is required to address the bank's mandate. I've spoken about that. The structure of the land bank's funding model, I've spoken about that. It's very important. It speaks to development. It speaks to the mandate. The low credit profile, post-default, and market confidence is still in the rebuilding phase. We have engaged our shareholder to assist us in closing that gap, as I indicated, and we will be submitting an application as part of ensuring that the bank can support the developmental mandate. I also reflected on the grant funding issue that remains very important to ensure that transformation and development doesn't get impacted. And just quickly to reflect on the financial sustainability of the bank, we need to generate sufficient revenue and build strong liquidity and capital to ensure we are sustainable. That's the fundamental point here. And the funding discussions we spoke about will enable the bank to be able to on-lend more and grow its loan book, supporting the sector. It needs to be done in a responsible manner, which we have been doing, to ensure we generate sufficient profits as well to build a strong reserve and equity for the bank, so that Land Bank is a financially sustainable organization. The bank's core business is to finance agriculture. A number of considerations for financial sustainability in this respect would speak to our ability to grow the loan book, as well as quality of earnings that come from that. We need to make sure that we are lending responsibly and not have high NPL ratios. We have policies and models in the bank that help us to manage those risks. We also have a revenue diversification work stream. There is a team that's looking at different revenue diversification initiatives that we are piloting this year, and hope to build on that as part of strengthening the bank's financial sustainability. Cost management has become very central this year. We are managing our costs very tightly to ensure that we stay on track. We need to do that while balancing relevant investment in the business. While we manage costs, there are certain things that we may need to prioritize to ensure that the delivery of the bank is not affected. And of course, after all is said and done, we need to be able to generate enough cash. Couple that with sourcing cheaper funding is going to contribute significantly to the bank's financial sustainability. Just quickly, these graphs just show you the trajectory of various metrics given the different initiatives that are at play. So you see on the top left graph there, with the pilot program we're running on diversifying revenue, we expect that to start growing into the future, while we continue to grow our net interest income, which comes from loans that we give to our clients. And then of course the loan book will continue to grow as we support the sector, and it needs to be done in a manner that manages non-performing loans, because if that gets out of hand, it then impacts the quality of our balance sheet and will have negative consequences in terms of financial sustainability. So it's something that we keep a close eye on to make sure that it's kept within board. And the cost management will continue to be a very important focus area even going into the future. Some of the spikes you see will emanate from the investment I spoke about. For instance, we need to invest in ERP and IT technology, and these have deadlines. They have to come in at a certain point to ensure that we don't pose risk to the operating ability of the bank. And just closing off this slide, again, you see how the mix of funding is forecast to look into the future as we raise more funding, coupling that with equity and reserves, and the cash balance position as well will be growing into the future. I won't spend much time here. I think these slides are too detailed, but really the slides you saw before is a summary of what is on here. So you can have a look at this in your own time if you want to look at the details. So I believe I'm drawing to a close soon. I know I've been speaking for long. But what's important for us is to keep in mind the desired state of the bank. So you see this slide has a bit of history to it. So it's a slide that we can say was developed a few years ago while we look to resolve liability solution, which has now taken place. We stabilize the bank. Now we are going into the growth phase, and I reference the 3 stages of the turnaround strategy that was adopted by the board, which will get us from stabilization, consolidation, and growth to get land bank into a state that is desirable. A number of elements need to be managed very well for us to get there. I spoke about the funding profile of the bank. We need to have cheaper funding that is long dated to ensure we can support the mandate of the bank. Given the mandate of the bank, there is an argument and there is merit to consider some sort of continuous capitalization for the bank to support these developmental farmers. Couple that with blended finance grants that have proven to be very useful in the transformation and developmental mandate of the bank. And of course, in the middle is the operating model. So what becomes key there is to ensure that the bank strikes a good balance of development and commercial or financial sustainability. We have 2 divisions, if you like, in the banking divisions. One that is a core focus on development, and the other one that would service non-blended finance clients. And it's important to have that mixture because the one then helps to subsidize the other. So the 2 models or 2 divisions are still kept, and it helps us to manage our dual mandate, which is develop the sector while being financially sustainable. And our lenders will also want to see that our loan book, is not unnecessarily unhealthy, that there is a good mix to balance the risky side by the non-risky side. So keeping that balance is very key as part of our model. Of course, we keep saying we are an ecosystem coordinator, and this is important given our mandate. A number of the emerging farmers that we support, maybe first generation farmer, they may not have the right experience, the right expertise. So we have partnerships with service providers that could and would support farmers with pre and post finance support. Of course, those would need to be financed. And part of the funding model must resolve the funding structure of these support programs. But we see pre and post finance support as a necessity. It speaks to the mandate that the bank must fulfill. Linked to that is partnerships to create market access for these farmers. We've signed up a number of partnerships with large off-takers, the likes of Woolworths, Tiger Brands, etc., where our farmers that produce the required commodities that meet the standard of the off-taker can have direct access to that market. And that is very important for us, because to finance a farmer who then doesn't have a place to sell their produce, it becomes fruitless effort. And so we're very intentional on ensuring we can support farmers also with market access. And of course, the outcomes of all this is that we will be financially sustainable, will fulfill our developmental mandate while maintaining strong governance and complying with ethical requirements. while I draw to a close, so I want to just reflect on some of the risks/dependencies that we see. So the ability for the bank to raise funding, to augment our internal own resources, to enable repayment of the residual funding is very key. So I indicated early next year, the current liability 5 solution comes to maturity. That debt needs to be repaid. So we are busy discussing or talking to various funders to raise cheaper funding that's long dated, part of which is to help us refinance this expensive liability 5 note. So it's a key dependency that speaks to how the bank and whether the bank becomes sustainable going forward. The discussions we've had so far with our funders are encouraging. The discussion we've been having with National Treasury has been encouraging, given they are our shareholder and the funders would want to know the role of Treasury in ensuring that the bank becomes financially sustainable. Getting the right mix of funding is also very key to ensure that we fulfill our mandate. For customer finance affordability, blended finance remains critical. I've spoken about that, and having a strong balance sheet is going to be key for the bank as well, to ensure that we also can withstand economic shocks when they arise. And of course, we continue executing on our strategic initiatives. I referenced the revenue diversification initiatives at play, the NPL remediation, which will include increased origination, preserving and rehabilitation of our current loan exposure. Coupling this with efficient cost management is very key to our sustainability. I think this is the last slide, if I'm not mistaken. It summarizes essentially what I have referenced. The current state of the bank is that we are undercapitalized. That means we need to strengthen the balance sheet. Some support from National Treasury will be important to assist with this turnaround. The bank has already been in detailed discussions with potential funders to raise new funding. As I indicated, the discussions have been positive, but there are some dependencies that we need to close the gap on. The current asset liability mismatch is not good for the financial sustainability of Land Bank, and that gets addressed by raising new funding that is long dated. Insufficient grants, because of the growth of blended finance and the demand that we're seeing, there is merit in seeing increased grant allocation for blended finance to ensure that more beneficiaries can take advantage of this scheme and we can truly commercialize the emerging farmer segment. Liquidity is a very key issue that we're keeping a close eye on this year, as we are continuing to service our LS5 obligations, continue to disburse loans to our client base. It does mean that we need to get new funding sooner rather than later. And so it becomes a very important issue for us to manage. And of course, the guarantee framework that we're in discussion with National Treasury becomes very important to help us navigate this current situation. I spoke about critical enablers for financial sustainability. I will not repeat this because this is a slide I just spoke to before now. Okay, that was not the last slide. Apologies, Honorable Chair. This is the last segment, just to highlight some legislative and policy considerations for the committee to keep in mind, but more importantly, to assist to resolve this, given they speak to how the Land Bank can truly fulfill its developmental and transformation mandate. So there are a number of policy considerations that need to be fleshed out. One is the recapitalization support. If you recall, I referenced how the apartheid era land bank was supported and what it did to support white farmers. And the evidence is very clear. You see it today. We've got the history, we've got the facts. We bump into a number of old land bank clients that tell us how the old land bank in the apartheid area supported them to get to where they are today, and that was enabled by state support. Two is the sovereign guarantee framework that is required for the bank to emerge out of this turnaround strong. The concessional developmental funding, the grant funding for blended finance is very key to ensure we continue to commercialize emerging farmers. And climate adaptation finance and long-term agricultural infrastructure finance are also key policy considerations that would like to bring to your attention. Honorable Chair, that brings me to the end of my presentation. I know that was quite a mouthful, was a long presentation, but hopefully it gave you a good sense of the work that's on the go and some of the considerations that we need to keep in mind and issues that we need to resolve. Thank you so much.
Thank you very much, Mr. Mphambo. Let me take this opportunity to greet all in the meeting, honorable members, the team from the Land and Agricultural Development Bank, committee support staff, and everybody in the meeting. I've also noticed that Mr. Squacha, who's also a former member of parliament, has joined the meeting. And once again, Team Land Bank, thank you for the presentation. This, for some of us that have not been with this committee for the past years, is part of the induction, and we've been taken through and be given an insight knowledge of what is happening within the land bank. I'm now going to take this opportunity and give members a chance to engage on the presentation. I'm going to note hands. The first hand is that of Honorable Khadebe, then Honorable Siwisa, Honorable Majola will be the last. Honorable Swart, you'll follow Honorable Majola. In that order, Honorable Khadebe, you may start.
Thank you, Honorable Chairperson. Good morning, everyone on the platform. First of all, I'd like to appreciate the presentation made by the Land Bank. But what is critical out of this presentation is the fact that they do acknowledge their weaknesses. Because in order to solve any problem, the first thing which you have to do is to acknowledge that you are having a serious problem. So what is critical here, Chairperson, is that the mandate, actually the constitution of the country, is very clear that we must heal the past injustices. One of the fundamental past injustices was the issue of land. That's why the issue of the land bank becomes so critical. So it is disturbing that in 1999, the model which was used to finance the farmers, was changed to go to the market. So basically, the white farmers which we are having now have benefited so much. When it's supposed to go to the historically disadvantaged farmers, it was taken out. But you cannot cry over a spilled milk. The issue is, what are we going to do? First of all, Chairperson, one, I'll agree with the Land Bank that there must be regular capitalization of the land bank from the side of the treasury. Because what happens here is that they can also do that through the ring fence type of capitalization. Let's say that if the treasury decide that we are going to set aside 2 billion per annum, that one must be dedicated straight to the historically disadvantaged individuals, because there is no way they are going to compete now in this market without that support from the side of government. Number two, Chairperson, I'd also like to appreciate that they improved. They have improved on the issue of the financial management, that they've moved away from dilemmas and then now they're in a better position they're in. But what I'd like to ask is that what is the attitude of the Land Bank, in particular when coming to the issue of the Transformation Fund, which was touted by the Department of Trade in Industry and Competition? What is the attitude to are they in support of such a fund or not? And the other issue will be the issue of the relationship with SOEs like the PIC. The PIC is sitting on a gold mine of more than 2 trillion. No, the government the government employees insurance fund is sitting at a gold mine of more than 2 trillion rand, which I think that if they have a proper networking and proper relationship with them, it can actually be able, because as I said, it's an SOA, to fund the bank at a preferential rate. So what is that one? What's the attitude on the 100 billion transformation fund? What is their relationship in particular with the government employees Lento pension fund through the PIC? Do they have to structure that? And then the issue again, what I liked with the presentation is that they want to help the emerging farmers with the markets. We know that before 1994, there were commodity boards, whereby the commodity boards were used to ensure that the products of the farmers then, they go straight to the market. It means that the market is guaranteed. But right now we know that we open up the economy. What is the attitude of the Land Bank in helping the emerging farmers with the markets? In particular, you can take, for example, China has opened the commodities from South Africa duty-free. What is the plan of the bank to help these emerging farmers so that, because that one is almost guaranteed that they are going to get there at a preferential rate at a better terms? What is the attitude around that? The last one, Chair, I'll come back later, is the issue of the stability, because in order to have a vision and sustain it, you must have a strong executive, you must also have a strong board. I don't know where we are seated now, is the board interact? Is the executive interact in the form of the CEO, the form of the CFO, or even the chief operating officer, whatever the structure it is it interact? Because it is through such structures that the vision can be taken forward. As I said, Chair, when I open up, I really support them on the request for recapitalization continuously, because this one is a constitutional imperative. We cannot look any other way, because what is going to happen, it can create an instability. We are 32 years into the democracy. When you look at the landscape of land ownership in the country, it's very skewed. It's very skewed. And those people who benefited in the past, they're actually growing in leaps and bounds by day. So I think that for the sake of the national security of the country and the peace, there must be some sort of a quick, as I said, quick redistribution of the land, quick support of our historically disadvantaged farmers so that they can compete effectively.
Thank you, Honorable Khadebe. Honorable Sibisa.
No, thank you, Chair. Greetings, Chair. Greetings to the members of the committee, support staff, team Land Bank. Chair, let me also welcome the presentation. As you've alluded, it's the first time, so we are going to keep on learning the mandate and the role that the Land Bank has to play. Chair, I've got one concern, and because the presenter was speaking about there's a lender who did not manage to pay his loan, and it brought the land bank into the balance sheet not balancing and as it's supposed to be balancing, Chair. Now, whether matter of commercial farmers or your startup farmers or your new farmers that are starting to go into farming actually, and they go to the land bank to request for a loan, and they are given the loan. Now, my concern is whether continuous disasters that we are seeing, especially in your KZN, in your Northwest, whereby we speak about rural areas, we speak about land. Some of those people have actually went to the land bank, and I stand to be corrected. If they've gone to the land bank, they got a loan to buy the land and to actually start farming on the land, and these disasters come, it means that their crops are going to be damaged. Their livestock is going to be affected. And we know that with the previous presentation from Sasria said that their mandate does not cover for disasters for farmers. They are still going to apply to expand their mandate to ensure that when they speak about disasters, they also include, we don't only speak about small businesses, but even farmers are small businesses, that they should be included. Now, I want to check with the Land Bank, in an instance whereby an applicant got the loan and find themselves that they cannot repay the loan because of the disaster, the crops that they were planting became damaged. Because some of these farmers, Chair, we must face reality. They are new farmers. Some of them can't even afford to take out an insurance like other farmers that have been there to say that if there's a disaster, then I know that my insurance company is going to pay me out for me to recover and even pay for any other things that I might be faced with. So what does the Land Bank say in an instance of disasters on farms, especially to their lenders, those that they have given money to, and they find themselves in that situation of their crops being damaged through disasters, your rains and your storms that we've noticed over the past few years? What is the mandate of the Land Bank when it comes to rescuing those farmers and making sure that they do not become blacklisted in such a manner that whatever any other property that they have is going to be repossessed? That will be my only question, Chair, because it's very alarming. I heard that there is risk and non-risk and management and everything. But the first and foremost thing is that land is all that we've got as South Africans, and land is the only thing that we can survive with in South Africa. And if we cannot maintain our land after taking a loan, then it means that we are back to square one. It means that there's a possibility that the land will be taken back, and then those farmers will be left without any other source of income, even increasing the unemployment rate that is already high in South Africa. That's my only question, Chair. Thank you very much.
Thanks, Honorable Singisa. Welcome, Honorable Majola.
Thank you very much, Honorable Chair. Greetings to colleagues and the team from Land and Agriculture Development Bank of South Africa. Madam Chair, let me also join the queue in terms of welcoming the presentation. And Madam Chair, without repeating what the previous speakers have been indicating, let me also concur with the statement or the concern regarding the current versus the previous funding. Madam Chair, arising from the presentation that previously the Land and Agriculture Bank was funded 87% by the state, which currently they have to go and look for the debt capital market to fund their operations. Madam Chair, I quickly Google the current status, which speaks to this consent, and as Honorable Hadebe indicated, well, the current situation reflects that, where the 80% of the population in this agricultural sector owns only 4% of the agricultural land. So, well, this needs an agent, as Honorable Hadebe indicated. But having said that, from the debt capital market, the presenter indicated, he highlighted the loan that they secure versus the loan that they provide. Well, in a nutshell, he was indicating that from the percentage that they have been charged, they have to accommodate the markup to sustain the finances of the bank. I want to check my first question as to, from that scenario, what is the current interest rate that they are charging to their lenders? The second question, Madam Chair, is with regards to the comment that there is a good relationship with the National Treasury in terms of reversing the funding models. I want to check, as we are busy doing the appropriations, what are the discussions, what are the levels of discussions are we going to see in future approving appropriations to the land bank, whether through the Department of Agriculture or through as a state entity like ESCOM and whatever, just to get the levels of the negotiations in terms of the good relationship the bank has with the National Treasury. The last one, if maybe the presenter can indicate in numbers between 1994 and now, in terms of their success rates, how many success farmers they have benefited from their initiatives. Can we invest our support based on the success stories that they have provided in the recent years? Thank you, Madam Chair.
Thank you, Honorable Majola. Honorable Swart.
Thank you. Good morning, Honorable Chairperson and members. There's one question that Honorable Radgadebe had asked, and that is one of my questions about the board intact, and the chairperson. So that one was dealt with. The other one was just Honorable Debbie has said, after 32 years, land, the ownership of land is so skewed. It's 32 years along the line. But there was a question and answer early last year that there's so many state farms that's laying there waiting for ownership. Farmers that received productive lands and agriculture businesses, and then a year after that, nothing is happening. So the question is, where is and where were the agricultural bank? So it's not about the 32 years, about people interested in farming business. One or two or three questions, Honorable Chairperson. The bank reported a profit of 486 million in 2025. How much of this profit resulted from normal lending activities versus interest and on government recapitalization funds? Then on the presentation indicates that an application for additional capital support has been submitted to National Treasury. How much capital does management believe is required to place the bank on a fully sustainable footing? Because I agree with Honorable Khadebe, we need to support our entrepreneurs, farmers, our upcoming farmers. But you know, the question is just it's 32 years, and what happened? What happened in between that we don't see really, strong commercial upcoming farmers became commercial farmers. So the capital needed from the bank, to be fully sustainable and supportive of our farmers. And then 2028, if no additional government support is forthcoming, can the bank still meet all its obligations beyond 2028? Then on transformation, Honourable Chairperson, only 62 clients from designated groups were supported. Land Bank exists partly to drive agricultural transformation. How many black commercial farmers have successfully graduated from emerging farmer status into sustainable commercial operation during the past years? Why is the Western Cape significantly underrepresented in the client portfolio? Is it due to demand constraints, funding constraints, or Land Bank's lending strategy? That is my questions, Chairperson. Just a note, while we welcome the improvement in audit outcomes, the reduction in debt and conclusion of liability solution, the central question remains, has Land Bank solved its business model? Or has it merely postponed its funding crisis until 2028? And that is what Parliament needs clarity on, whether this institution can eventually stand on its own feet without repeated taxpayer intervention. Thank you, Chairperson.
Thank you, Honorable Swart. Colleagues, we are joined by Honorable Montwedi from the Select Committee on Agriculture, Land Reform and Mineral Resources. He requested to be part of this morning's committee meeting as he has an interest on the matter before the agenda. Honorable Montwedi, you are welcome and you may make your submission.
Dumelang to everyone in the meeting. Chairperson, I just have a number of issues that I would like to raise with the bank. The CEO in his acting CEO, I'm not sure if still the acting is the CEO, but in his presentation, he did touch on the issue of that the cost of borrowing is too high. Yes, indeed, the cost of borrowing is too high, and we need to really look into that issue of the high cost of borrowing. But I want to then direct my question to say, how do you determine the cost of borrowing on farmers that are participating in the Land Bank blended finance scheme and an ordinary farmer who would want to come and participate directly with the bank on other programs of the Land Bank? So are you saying farmers, irrespective of whether it's blended or not, they still are subjected to the same interest rate? Why that is the case, if it is like that? Because at least the blended finance, it is supposed to cushion farmers with regards to that aspect. Now, the first question, that is the first question. The other question, Chair, that I should have actually rather started with. We know this is the second time that the blended finance was introduced. We know that it dismally failed before. And the current chair of the Land Bank Board, when he was the deputy minister that other time, I think they introduced that program around October 2022 or 2023, this current blended finance program. Now, and you indicated that there is pre and post funding. Now, I want to ask you to say, if a farmer needs funding from the bank, how does a farmer access the pre-funding support? Because when the former minister Togodi Disa announced, spoke of the pre-funding support, how does the farmer access pre-funding support so that a farmer avoids a situation where they go through the process of a mentor that go and exploit farmers under the guise of helping farmers, when in fact it's mentors that benefit more than the actual farmers? So how does that, how is that accessed? That is the second question. The third question, Chair, is that Land Bank, you are not implementing this blended finance program on behalf of the Department of Agriculture for free. You are an administrator of the fund where you disperse funds to other DFIs, your others, I forgot them. Yeah, we know those other DFIs, where you administer the funds and you're also an implementer. And there's a fee that you're getting. So since implementing the blended finance, how has that fee that you get from implementing the blended finance assisted you with liquidity crisis that continuously you're talking about? Because it runs into millions and millions of rent that you are getting as a bank as part of a fee that is paid for implementing this program. How has that assisted in the liquidity of the bank, number one? And number two, in building capacity in the bank? And capacity, CEO and chair, I'm referring to a situation where I visited one branch of the Land Bank. They couldn't understand how does a sprinkler irrigation work. No, we're used to pivots. No, but there are different types of irrigation. You find far-off, sprinkler, whatever, and they couldn't understand. So how have you built capacity in the bank so that your bankers should be able to know some of these things and that they're able to assist farmers? My fourth issue, Chair, you mentioned that some farmers are unable to repay their loans to the bank. And then that affects the bank negatively, so that when you go to the market, you are unable to get more resources because of the challenge of farmers to pay you. But we must tell you here, Land Bank, that you yourself are failing farmers. How do you expect people to repay their loans when you, as the bank, struggling, you are failing to disburse money in time for production inputs to farmers? How have you improved your systems to be responsive to farming as an enterprise? Because some of the farmers that have failed to fund you, it's your man-made crisis where you delayed to release the funds. A farmer goes into a production season without having gotten the money that they need, without having planted. I can cite you an example of a farmer in Hartswater in the Northern Cape, where they are harvesting pecans now. They've started to harvest pecans, but you've never given them their production input. A year ago, they were able to sustain their production, borrowing money there and there, but you have never given them their production money in time. So some of these things are your own creation by failure to support farmers in time. Not only that, during the portfolio committee visit, when I was in the NA, we visited a certain farmer in Delareyville, that other woman gets a farmer, yeah, that area. The farmer says, it's better for me to go get money from the corporacy rather than the Land Bank, because you take time to approve and deliver on the funding, number one. Number two, he says, these people of the corporacy, they don't just put seed on the ground. They follow the seed up until it is harvested. You give farmers money, there's support that you do not support our farmers so that whatever that they put on the ground must, at the end of the day, germinate. Now, the last thing, Chair, is around, which I'm a bit skeptical about, to say, sometimes people would say, how do you fill someone's cup when yours is empty? Ne? But your cup, land bank, is full. You are failing to implement the blended finance program. Your policies are not agile to supporting the agricultural sector. Tomorrow you are going to blame white farmers who are willing to put their farms for sale, saying that they are not supporting the blended finance. Why? You take a long time for your approvals. White farmers, most of them, they say, if the land bank, we want pro-approval. You're not even at that stage where you're doing pre-approval, where you say, let's assess you, we pre-approve you, and then you go and check a property that you'd want to acquire, and then we come so that the process is quick. You take long to approve transactions. Farmers are fighting. Sellers are no longer willing to be with you because of your long time that it takes to approve transactions. Department of Agriculture, that is not here. I'm not their mouthpiece, but they are not happy in terms of how you are implementing this. So I want to please call upon you as the land bank to please bring the necessary reforms. In the budget debate of agriculture, we raised that to say, bring reforms that will respond to the urgent need of farmers on the ground. But in your current format, you as the land bank are failing to be responsive to farmers because of a number of those things that are raised. I don't want to talk long. I don't know how the chairperson operates here. She'll end up saying, hey, keep quiet, Wena, because I know in my space in that committee, I talk long. But those are some of the things that I just wanted to raise. But this is a very good program, the blended finance. We must support it. We must be deliberate to support our farmers because some of these banks are refusing to fund black farmers. Even when a black farmer comes with a 3-year or 4 or 5 years financial statement, they look at the color of your skin and refuse to fund you. But the land bank, you are able to do that. But don't trap our people by giving them farms. You delay to give them production input. If you are interested to know the farmer that I'm talking about in the Northern Cape, I can tell you who is that farmer. But I don't want to do it here. I'm just telling you to say, go and help our farmers. With that, modula stilo wa ka o rategang e kgarejana e tswa mo provinceng e rena entle. Ke go lebogile. Thank you.
Thank you, Honorable Montwedi. At least you were able to cut yourself short. I know you can go lengthy in discussions, Honorable Brits. Then Honorable Numalo, you'll be the last.
Thank you, Madam Chair. Good morning to everybody on the platform, especially my thanks to the Land Bank for their presentation. Madam Chair, with your permission, I'm going to leave my video off due to instability of my system. I have a couple of questions. First, regarding financial fragility of the bank. Now, it's clear that the bank still faces repayment obligations through to 2028, and that most probably you will need to secure fresh funding before then to avoid further liquidity problems. Now, my question is, has the Land Bank postponed its funding crisis, or have you fundamentally restored your long-term sustainability in this regard? Secondly, I want to talk about your bad debt situation. Now, higher bad debt levels reduced the bank's ability to lend money to emerging farmers, and it increased the risk of future losses. Now, my question is, how much of the loan book of the Land Bank is genuinely recoverable, and what percentage is likely to be written off? Because that's going to have a severe effect on the bank's ability. Thirdly, reduced impact. Now, if I understand correct, lending capacity fell from around 45 billion rand before the crisis, and I'm talking about the 2020 crisis, to roughly 17 billion thereafter. Now, this means that fewer resources are available for emerging farmers. I also think of land reform beneficiaries and then agriculture transformation. Now, my question is the bank still fulfilling its mandate in respect of development, or has survival taken over transformation? Fourthly, Madam Chair, looking at future funding risks, if I understand correctly, the bank has indicated that it will need additional funding by 2027, 2028 to maintain liquidity and to meet outstanding future obligations. Now, according to me, this raises the possibility that further state support will be required. My question is simply, will taxpayers be called upon to rescue the bank in future? Fifthly, Madam Chair, looking at cybersecurity, I haven't heard much today about cybersecurity, but it is widely known that early in 2026 there was a significant cyber incident, and I've even seen reports that a ransom was demanded from the bank. Now, the bank never confirmed or denied those claims. Now, my question is, what data was compromised, which systems were affected, and what has been spent by the bank on cybersecurity thereafter? Then, coming to audit weaknesses, what is the current value and the percentage of the bank's non-performing loan portfolio? And I think this links to the previous speaker's question, but the current value and percentage of the bank's non-performing loan portfolio has a significant impact on the bank's ability to make funds available. Furthermore, what contingency plans exist if the bank cannot raise sufficient funding before 2027, 2028? I've referred to it earlier, and that outstanding debt raises an issue. But what is your plan if you cannot raise it? Then I would also like to know, Madam Chair, how much lending capacity has been lost since the 2020 default? Surely you've sold your book, and lending capacity must have been influenced and affected. And then lastly, Madam Chair, what portion of your current lending really reaches emerging and previous disadvantaged farmers compared with commercial agribusinesses? Thank you, Madam Chair. Those are my 10 questions, I believe.
Thank you, Honorable Brett. Let me invite Honorable Mumalo.
Thank you very much, Chairperson, and my humble greetings to your good self and all the members of the committee. Chairperson, I want also to acknowledge welcome the presentation by Land Bank, which talks to agriculture as a main issue or main target in the whole presentation. Chairperson, my question to Land Bank, as I acknowledge their presentation, to say that agriculture is one of those program that must be put on top because it's talk to food security. Chairperson, in terms of in their presentation, they talk about having make sure before that they were looking at or they were prioritizing white farmers. So I want to know if ever they've got a transformation strategy that will make sure that the previously disadvantaged communities or farmers are being taken care of, to make sure that they understand one thing in terms of training, to make sure that they understand the issue or the handling of finances and all those things, so that they can be at the same level with the those who were advanced, like the white farmers. So how far are they with that program, if there is that program at all? And Chairperson, the other issue which I think one of my colleague has touched on is the issue of land distribution, because really there's a problem in terms of land distribution that we normally don't have, like the percentage are still very low. So how will they assist small farmers or emerging farmers to make sure that they have access to those lands so that they can be able to do their work fairly so? The other issue which I wanted is the target. What is their target in terms of making if ever as part of their APP, to say that if ever we have done so much, if ever we have funded so much is in terms of category emerging farmers, advanced farmers, and all those things structurally, so we'll be saying that we have reached our target. And the other one, I think one of my colleagues has touched on it. I won't go back to it. I think these are the only question that I'm having in terms of land bank, and also to say that I acknowledge their presentation. It assists us to know how they are operating their implementation plan moving forward. Thank you very much, Chair.
Thank you, Honorable Ngumalo. Mr. Mpambo and the team, mine is just to check with you whether you can table to the committee the exact tenure profile of your current loan book versus your funding book. And are you in a position to maybe quantify the mismatch in the years? That can be done in writing because it might need time for you to consolidate that for the committee. And maybe just out of interest, I want to check if you have a contingency plan to avoid the second liquidity shortfall for the year 2028 in case Treasury approval for the sovereign guarantee and new capital injection is delayed beyond Q3 of 2026 and 2027. Those are my two questions. Most of the questions are covered by members. I'm now going to invite Team Land Bank to respond to questions through you, Mr. Mpambo.
Thank you, Honorable Chair. And the questions are well received. And thank you for the remarks. I will do my best to answer majority of the questions. Maybe just to flag to my team on the finance side, especially the last set of questions on the tenure and the miss, depending on the level of detail that is required. I'll just request if the CFO can step in there once I have responded, including the question on the transformation fund. I can briefly speak to it, but either the CFO or Priscilla can respond to that as well. Honorable Chair, I will go through each set of questions as they came. From Honorable Hadebe, I think the question of the transformation fund was his first question. I'm looking at the questions and not necessarily the remarks. So I'll request the CFO and our acting AM for Treasury to speak to that. Suffice to say, the bank is in support of any program that seeks to progress transformation. And at the core of our mandate, as I reflected, is not only to develop the sector, but to transform the sector. So any avenues, and there will be different programs, different instruments that seek to address transformation, we would, in principle, subscribe to such programs. The question was really on our posture or attitude around that. On the issue of the relationship with the PIC, and also I request the CFO and Priscilla to speak to this as well. Of course, PIC is a sister company of ours. we do engage. They are also, one of the funders that are part of the Liability 5 program. So we do have a relationship with the PIC as a lender, but also as a sister company. In some instances, I think we had exposure to some of their agribusiness investee companies. So that relationship exists. We do have engagements with them as it relates to that. The pension fund, directly, I think the past engagements would have taken place with the previous CEO who left early this year. He used to have such engagements as part of unlocking, a bigger partnership with the pension fund. They are on our radar. You recall I just took over as acting CEO in mid-March as well. So if you are referring to engagements with the pension fund, of course, it's something that's on our radar for us to progress on. There was a question on attitude around Land Bank providing market access. China was given as an example. As I indicated in my presentation, one of the roles the bank seeks to play and is playing is to unlock market access opportunities for farmers. Of course, currently the focus has been local. I referenced some of the market access partners that we have signed agreements with. We continue to explore the landscape. In fact, this morning we had a meeting with potential partners from China who are working with the University of Mpumalanga around rice production. So that is another avenue that we are exploring as part of opening up channels for potential farmers. So when we have such opportunities, we take interest in that, like we did with this one that just came now, and we'll be having further engagements with them. Some of the stats they shared were very interesting, in that South Africa exports more than 90 or 80% of rice, and yet there are opportunities here where we can produce rice or reduce the import quantums. So it's just another example to say, beyond local partnerships that we have already unlocked, we continue to scan the market for more opportunities across different commodities that would assist us to provide access of market to our clients. The executive and board interaction, I wasn't too clear exactly what this means, but I can indicate there's a very good relationship between the executive leadership as well as the board. There are regular engagements. Of course, there are set quarterly meetings that the board holds, but beyond that, there are regular engagements that take place on various issues between the board and management. And there's also a question that came later relating to the board. We have an intact board. As indicated, Mr. Squatcher, who joined the meeting here, is our chairperson. This board came into office sometime last year around September, October, and have been at work since. So in short, the board is intact, and we have a good relationship with the board, including the chairperson. The next set of questions from Honorable Suwisa was speaking on how clients that have been faced with disasters are assisted by the bank. And it's a very important question. And it also touches on some of the structural issues I highlighted earlier. So when we provide funding to clients, one of the things that we require clients to have in place is obviously insurance. As part of blended finance, there is a portion that the blended finance grant is dedicated to unlock insurance for these blended finance beneficiaries or blended finance clients. That is part of the avenue that is used to address the issue of disasters. However, as you've mentioned, there are some that may not be covered by some insurance companies. I believe drought is generally not covered, which, it doesn't help because the time where a client needs it is when the insurer says, we can't give you support. We had engagements with the DG at the Department of Agriculture around these kind of issues. And one of the ideas or initiatives that we sort of started talking about is a concept of a disaster fund, whose purpose would be to step in instances where either insurance doesn't cover that disaster, or perhaps a client didn't have insurance for whatever reason, and yet we know that if they don't get assisted, things can go in the wrong direction. So a concept of this disaster fund is something that could potentially be explored. Of course, it needs to be funded. It's still, as I said, a concept. We just discussed it at high level. You would be aware this year, starting last year with the FMD adding the increased input cost arising from the Middle East crisis, a number of farmers would be under pressure. And I have engaged with, the DG at the Department of Agriculture, and I'm conscious that he is also aware that something may need to be done to assist farmers given these extraordinary circumstances that have arisen. So a concept of a disaster fund is something that could come to assist there. So the bank assists in that we encourage clients to take insurance. We also, looking at the circumstances of a client, are able to restructure their loans. Typically for an emerging farmer, that may require some sort of input from the department. We have done so on a number of occasions where a farmer has gone through distress arising from external factors. So when their loan becomes due, we would restructure it to say this loan can be paid in the following period or over a certain period. Let's get in the department to assist and help us structure this loan. In some instances, that input by the department may not be necessary because the client themselves are more healthier for us to just structure their existing exposure and defer some of the payments so that once they're up and running, they are able to honor their obligations. So that is one of the active roles that we play, is to assist clients to proactively restructure their loans, in addition to insurance that would come in to assist. We have also explored the concept of credit guarantee. I believe it's one of the work streams that our head of treasury is working on, and maybe she can step in later to just add some more detail on that. So a credit guarantee would be, let's call it a pool of funds that will be available. It works like insurance in a way that whenever a trigger event happens, we could then look into it to assist certain clients. Of course, we'd need to pay a fee for that, but it's one of the mechanisms that as a bank we're exploring given the mandate we serve and the clients that we serve. A number of the clients in our space would ordinarily be negatively impacted by such events like drought, that without assistance it may be difficult for them to recover. And then moving on to the next set of questions from Honorable Majola. I think the question was around the interest rate charged by lender. Was it? You said by lenders. I presume you're asking about us. So we can give you a sense on both. So the current liability 5 solution that we have in place, Land Bank gets charged in the region of prime rate, just below prime, but we can call it prime because the margin is very small. And so that's what we get charged. We then have to add a margin on top of that to clients for loans that we extend to them. And that margin is necessary because the bank has got costs it needs to service, it's got obligations. We have staff that we need to pay, we have offices we need to pay, etc., etc. So whatever cost comes to us, there will always be a need for us to add a margin to ensure that we become self-sustaining. It helps if that cost that comes to us is low, because the margin we add will still lead to a low cost of funding for the client themselves. So imagine a scenario where we get charged, say, 5% for argument's sake, and we add, say, 2% on top of that. A client still pays 7%. So it's a single-digit charge. It's far cheaper than what they would have been charged if they went to a commercial bank, as an example. So that is and that's the crux of this funding issue. Without sorting this out, we'll keep circling around the cost that farmers are being charged. And really, to have a sustainable business, you'll need to ensure that there is sufficient margin to cover your operating expenses. The next question was levels of discussion with National Treasury. Will there be appropriations in future? So the recent discussions have centered on our current fundraising initiatives and the need for a guarantee as reflected by our potential funders. Linked to that, we have indicated to National Treasury that given the bank's current balance sheet strength, the funders have indicated that it needs to be improved, and that improvement will likely require a capital injection to bolster the strength of the balance sheet. If you think of it in private sector terms, when a company needs to either raise funding for growth or to strengthen their balance sheet, they will typically issue rights where the existing shareholder would then inject more capital into the business to strengthen its balance sheet or to support future growth initiatives. It's a similar framework here. It's just that it ends up being creating noise because the shareholder is Treasury. But if it was a private sector, the concept would be the same. The shareholder would need to step in and bolster the balance sheet of the organization to ensure that it can fulfill its objectives and support its program. Regarding future, what you call appropriations, I presume you're referring to allocations. I don't think this is something we can confirm. I referenced how the old land bank was financed, and in our assessment, given the mandate of the bank, we believe there is merit for some sort of continuous at intervals capital injection, not to rescue the bank, but to support the program. And there's a big differentiation there. And that is the decision of Treasury to take, so I'm not able to comment if that will happen or it won't happen. We're simply reflecting the current state and the mismatch with the developmental mandate, and also reflecting how the old land bank was financed. And then there was also a question on success rates from 1994. I don't have the stats from 1994. I can share some of the stats we've seen in the recent past, especially since the launch of blended finance. And maybe Tatana can, if you have them handy, you can share. But top of my mind, we have approved in the region of 5 billion loans and grants since the launch of blended finance, and we have disbursed just over 3 billion or so total grants and loans. This is to black farmers since about 2023 or so. And all this has contributed to supporting production land mass in the region of over 917,000 hectares, supporting or preserving job creation of over 6,000 across beneficiaries over 600. Those are some of the stats I remember top of my mind. And when you look at the blended finance book, one of the measures of, I guess, success is how much of that is performing versus non-performing. The current stats show that about 12% of that book is non-performing, which means the balance is performing, versus the overall NPL ratio of the bank, which is significantly high. And it's high because we sold a good portion of our book, and hence we're left with a sizable portion that is non-performing. It's a mathematical outcome. If you cut out a significant portion that is performing, your ratio is going to increase. That's why our current NPL ratio is where it is. But when you look at the book that we originated since the bank came back to market in 2023, 2024, that NPL ratio is very low. I think last time I checked was around 10% or lower. And then the blended finance is just slightly above the 10%, 12% I mentioned. So you can see that since we returned to market, the quality of the book we're bringing on board is good compared to where we sit with these legacy non-performing books. So hopefully that those stats give you a sense of the success rate. I'll move to the next set of questions from Honorable Swart. Is the board intact? I've responded to this as well. Yes, the board is intact. We have a healthy relationship as management with the board. I also indicated a good relationship with our honorable board chair as well. And then there's a question on what's happening to state-owned farming land. Of course, I don't think we're best placed to answer this question. We do play a role of advocacy in the land reform space. Some of the stats I've recently seen from our Honorable Wandile Slobo is that the state has acquired just over 2 million hectares of land from private owners, and that is meant to eventually find itself in the hands of black farmers. However, when you look at the progress of that transfer, it still seems to be quite slow, which is the point that Honorable Swart is making. And I think there's probably a broader discussion to be held there, and it would fit mainly within the land reform space. I'm not able to give an answer as to why that is not moving as fast, but it's definitely one of the areas that needs to be addressed as part of strengthening development and transformation in agriculture. There was a question on how much profit came from normal lending. So we can share the interest, not the profit, because profit comes holistically. So we do know how much interest was earned from normal origination versus money that came from government. So you recall that recapitalization, the money was ring-fenced for a period of time until Land Bank was able to fulfill certain conditions that were required by Treasury for that money to be released. So while it was sitting in that escrow account, it was earning interest. And post it being released, we then started using it to disperse and support the sector. So there is a period in 2025 where a sizable portion of the interest came from money that was sitting in Exco. But as we move away from 2025, part of that money is then used to support farmers by generating new loans. And I'll request the CFO maybe later to just share the split for that, what was from lending and what was from the escrow account. But we do have that that split. How much capital does management believe is required to place the bank is it on an equal footing? So the discussions we have been having with the Treasury is we are looking to raise 20 billion rands in debt funding from DFIs that can give us cheaper funding over a long period of time. That 20 billion will be drawn down over the next 3 to 5 years or so. Linked to that is a strengthening of balance sheet, which requires a shareholder to inject some capital. We believe 10 billion rands injection into the balance sheet to strengthen the balance sheet, and that will help reduce funding costs for lenders, for farmers as well. Will help the bank to get on a strong footing to fulfill its developmental mandate and be self-sustaining. When you look into the future, and this needs balance, the extent of the growth in the developmental mandate and uptake from emerging farmers also speaks to any potential future allocations that are needed. Because money that's given now is finite, it will support a certain number of people over a period of time. As you continue to grow support to more developmental farmers, there may be, as I've indicated, an argument for future not to bail the bank, but to support the farmer that is at developmental state, as the old land bank model was working. So, but if you are asking us now, the ask we have made or presenting to our shareholder is that this will help us to really be on a good footing to be self-sustaining. I'm looking at the next set of questions, still under Honorable Swald. If no government support is provided, can the bank meet its commitment beyond 2028? For us to meet our commitments beyond 2028, we need to raise funding now. And that funding requires, this is what our lenders are telling us, they require government to support the program for us to raise that funding. Without that support from government, it's clear that our funders say it's going to be difficult for them to give us new funding. So it's almost, it has to happen. Otherwise, it becomes a challenge. So 2028 must come with us having raised new funding, which we are busy with. I've reflected that we are at different stages with various potential funders. And then on the next question, how many black farmers have successfully graduated from emerging to commercial? Again, so it depends how you define emerging, how you define commercial. I think there may be different different definitions depending on how big the organization one sits in is. What we can share is that we have supported 600, since the launch of blended finance, 600 or so beneficiaries We have disbursed in the region of over 3 billion or so in loans and grants to these farmers. Most of the farmers that we are supporting, actually, if you are in blended finance, it means you are not earning anything above 50 million rands in revenue. That's the criteria. For someone who is a big organization or big corporate, they may say 50 million rands revenue. You are not commercial yet. But if you take a strict definition, one can argue you are starting to be commercial. So I think the fundamental point is, are we seeing growth in the beneficiaries that we are financing? Yes, we are. And I've reflected on just one example from Free State, who had no ownership of land before and now is going to be owning about 800 hectares or so. Once a client reaches 50 million rands in revenue generation, according to the blended finance criteria, they don't qualify for blended finance. So if you use that definition, now they start moving across to the other side. And then if I move to the next question, the one on Western Cape, I wasn't sure what the last part of the question. I just said, why is Western Cape significantly, I presume, is it underrepresented, or I'm not sure. If I take an attempt at this, I know last year Western Cape's performance wasn't what we had expected it to deliver at. The previous year, it was one of the top, I think, one of the top 3 or so in terms of disbursements that we gave to support farmers in the region. Last year, the province had some challenges with, the provincial head leaving. We also had some capacity constraints that we subsequently managed to close out, which of course impacted the performance of the province. So if that's what you are referring to, the answer would be the capacity constraints that we had, coupled with the departure of the provincial head, but also noting the prior year, Western Cape was one of our top provincial performers across the nine provinces. So it's not an issue that they have a problem as such. Last year just had its own challenges. And yeah, we don't have different criteria across provinces. So I think one of the questions you were saying, is it because we have different policies? No, we don't have different criteria across the province, the same policies that apply across the province. Has Land Bank postponed its financial challenges to 2028? This is a very loaded question. And I'll use the example of African Bank. When African Bank had challenges, I think it was 2014 or so, how they resolved that, they created 2 banks essentially. One was the Good African Bank, and the old one was the other bank was the African Bank that had the bad assets. So they moved majority of the bad loans into the One African Bank and kept the Good African Bank as the operating entity to continue operating. By doing that upfront, they solved the problem from the get-go. With the liability solution, when it came into effect, including the capital injection by Treasury in 2023, it was known that we will have an obligation to service come FY 2028. And the 10 billion, yes, it's substantial, it's massive, but also look at the fact that the bank itself contributed a significant amount to reduce its debt from 41 billion to now 6.7. So majority of that reduction came from the bank itself. Those efforts combined, unfortunately, still reflect that we will either need to roll the obligation in 2028, which we don't prefer to do because it's expensive, or we refinance it with cheaper funding. Of course, the decision of Treasury at any stage must take into account fiscal constraints, right? So there are reasons why it was done the way it was done, and it made sense at the time. Now we are at a point where we need to sort out or close off this 2028 maturity. And it will happen by us refinancing with cheaper debt. That is the approach we are taking as a bank, to source cheaper funding to refinance that. Treasury is also being requested to be part of that solution, because this is one of the ask that is seemingly coming from the potential funders we're talking to, and hence the MTF application I referenced that we will be submitting to Treasury. So the 2028 problem was rearing its head even at the time. Yes, I was in here, but you would know that if we have an obligation of X that must be serviced over the next 3 years, and our forecasts reflect Y in terms of new liquidity, loan repayments, etc., there will be a need for us to settle that loan. And by the way, it's not unique to Land Bank. Different organizations have to get to a point, or do get to a point, where their debt obligations mature, and they would either refinance with the same funders, or roll it over, or get cheaper funding, whatever. It's not unique. It's not unique to us. It's part of the phenomenon of using debt finance. When it comes to maturity and you don't want to fully settle it, you can refinance it, or roll it over. Of course, you need to have those agreements with the relevant funders. And then the next set of questions is from Honorable Muntwedi, who raised a number of operational issues in the bank. You recall when I was presenting, Honorable Chair, I made reference to the fact that we are not here to claim everything is working well, that we've done everything well. But what we want to reflect is there is progress, and we must not put that under the carpet. Otherwise, we create a picture that is not balanced, and it's not good for the sector. It's not good for farmers. It's not good for trust. And when I say I'm not claiming that everything has been done and we are sorted, it's one of the issues that Honorable Muntwedi has raised. In 2024, end of 2024, we went on a national drive to talk to some of our clients that raised similar issues around taking long to disburse on time, long processes, etc. So these are issues that we are aware of, and these are issues that we are working on. What are we doing to resolve them? Let's start with the production facility issue, where there were references that Land Bank, in some cases, disburses production finance late. What we have done now as a bank is to refine the production facility product and create what we call a revolving credit facility. The difference between a revolving credit facility and a normal production facility is that once a client has paid up to a certain amount on this production facility, which is now called the revolving credit facility, they don't need to go through a long process as if they are a new client. They simply need to produce 1 or 2 documents, and then they draw down from whatever has been paid. Think of a credit card, if you like. You pay some of it, you've got balance you can use, right? Of course, banks have got this product called revolving credit facility, but for some people, it may be easier to use a credit card as an example. So it shortens the administrative process for getting new production. That revolving credit facility was approved by board in our recent board meeting. I believe that was around April or so, and is now being launched into the market. It is our way of responding to these legitimate concerns and they are legitimate. And we heard them from clients ourselves. It's not Mr. Muntwedi who's telling us and we didn't know. We knew about it, and we went on a drive to find a solution for it. And this is one of the solutions that speaks to truncating the time for production finance to ensure we don't have delayed disbursements. So that's one on the production facility. What about non-production facility related disbursements? You may be aware, if you've been following our submissions, that one of the initiatives the bank has been running with is this process re-engineering across the entire bank. This bank is old. It was formed in 1912, and unfortunately in its history hasn't had much investment in technology, hasn't had much investments like what you'd see with other commercial banks. And there are a number of manual processes that are run across the bank. It's a legacy issue. And we say, how do we solve that to ensure we don't have this perpetuating problem which compromises the welfare of our clients and our funders? We then put together a process re-engineering team whose job is to look at the bank holistically across different work streams. We are starting with what we call the origination work stream, which speaks to clients. How do we then simplify this process and make it more automated so that we improve our turnaround time? One of the things that we are doing is to build an automated client relationship management system. It's going in phases. We've just tested phase one. And phase one really is us being able to link a client's data into home affairs, into credit bureaus, etc. So when you input your ID number, we can automatically pick up different information about you that assists our assessment. Mr. Muntwedi spoke about pre-screening. This process helps us to do pre-screening in a very quick manner because it's running off an electronic system. A client can apply from the comfort of their homes electronically, upload documents on this system. And once everything is uploaded, there is an automatic trigger that reports to a relationship manager to say, you've got this application. These are the preliminary assessments that I've been able to do. Take it further. Currently, that process has got manual interventions. It's part of the reason why we've had some of these challenges. The key thing I want to share here is we are doing something about it, and it has been a legacy issue given historically the bank has not invested as it should have compared to other banks in its IT system. Of course, these things are very expensive. If you look at how much some of these banks are spending, 5 billion rands on technology, the bank hasn't had, unfortunately, those kind of finances, and probably speaks to why these were not done. But we can certainly look at cheaper options like the one we are doing now that prioritizes our clients. So that speaks to more a medium-term solution because they are, the legacy issue has been the fundamental problem. And this is over and above the constant engagements that we have with our clients across the provinces. We do provincial visits. We identify some of the challenges when we are there, because certain things you'll only know if you're on ground. They may not be reported to you if you're not on ground. So that's in addition to a more permanent solution that's on board. And maybe lastly on this is to say the new model of the bank, which is what we call a coverage model. That means every client must be allocated a relationship manager who deals with them directly for all their needs. Requires that we also have a provincial head who looks after relationship managers, and on top of the provincial head is a regional head who looks after 3 provinces. This layer of management responsibilities also helps to drive accountability on the lower ground, on our officials in the ground. The model was adopted, came into effect in beginning of April 2024, and we had to then capacitate in line with the model. I think now majority of these critical roles have been capacitated. So the monitoring of activities on the ground will also be augmented by this structure. In addition to the medium-term, more permanent solution I spoke about, that is to automate our processes. There was a question from Honorable Montwedi on the pre and post finance funding program. The question is, how does a farmer access pre-funding support? So when we think of pre-funding, post-funding, maybe let me say pre-funding support mainly, it can apply to post as well. There are two avenues that the bank is working on. One is an in-house process or approach. Two is a partnership-led approach. The in-house process would look at us providing training to farmers, for instance, on issues such as preparing a business case, doing cash flow forecasting, some skills on business management. I think one of the honorable members mentioned that some of these farmers may not have that background. So we have launched a Farmers Academy in March of this year, purely targeted to addressing this issue, where in-house we can provide this soft training, if you like, to emerging farmers. It will help address the gap that is there. Then on the partnership side requires funding, because the partners we use don't do work for free. I don't think most of us would do work for free. So we need to be able to fund that program. In the long term, as the bank has built reserves, we would look to allocate some of our profits, much like you'd run CSDs as an examples or ESD programs. You allocate a portion of your profit to support this program, to support the pre and post finance support program, that we can enroll external service providers who would assist farmers on the ground. For instance, post-planting, some farmers don't know, is it time for me to put fertilizers? When do I start harvesting? These post-finance support programs are meant to bridge that gap, and we need to be able to fund them accordingly. One of the initiatives that being run in our treasury program is to unlock grant funding that would support such initiatives. This is something that the AM in Treasury is working on. But we have an internal Farmers Academy that for now is targeted at the pre-funding side to get farmers funding ready. We had a soft launch in March. We will be spreading it out across the province. And the question was, how does one access it? A farmer can reach out to their relationship manager or any of the provinces who can then direct them to the platform. And of course, as we build capacity on this, we would then be scaling it up with partnerships that are funded. Honorable Montwedi also asked a question on the capacity of the bank. So this was linked to how is the management fee that we're getting for managing blended finance helping to improve liquidity and build capacity. So if you take a look at our financial statements, you will see that we're making revenue in the region of income in the region of I think about between 1.1 1.3 billion. And our costs are also quite substantial. Farming requires us that would be on the ground, so we've got a noticeable staff complement that's spread across provinces. We have agri specialists that would need to do monitoring. We have the bankers that need to do origination, etc. So the cost base that we have, the revenue we generate, and if you look at how much we get from the administrative fee, it's in relative terms is small. It does contribute in some way because it's cash that comes to us. But I don't think it's an amount that you can say you'll build a castle with, just given the scale of our operations. So it contributes in a minute way to our liquidity and our capital reserves because it's a small amount, relatively speaking. The issue of capacity, I know it was linked together with this question, but I think it can be a standalone question on itself. How do we continue to build capacity in the business? Similar to the farmer side, where we have launched the Farmers Academy, we are looking to develop and launch a what do we call it? It's an academy for employees academy, that would provide upskilling opportunities in relevant different areas for staff across the bank. It's quite unfortunate, the example that Honorable Muntweti referenced. Of course, if it would be seen that there may be staff that don't know their job, it gets worried. I'm hoping it's not what he's saying. It could be different technologies have evolved. What they were trained in, what they know, may be stale. But the point is, we take staff development seriously. One of the avenues we are working on is this employee academy, and this is in addition to other support programs the bank provides to staff, which happens annually for training purposes, etc. And we have funded programs where staff can take on further studies that the bank finances as part of capacity building. I think I answered the question on reforms to improve processes. So that was the last question I'm seeing here. I'm just checking I didn't forget anything. Oh, there was a question on, the first question on interest rates that are charged to a farmer that gets blended finance. So the money that we get from financiers, whether it goes to a blended finance client or it goes to a non-blended finance client, it bears the same cost. When you look at the blended finance client and they get, let's use an example, they get funded 10 million rands. Half of that is debt and half is a grant. The blended cost of funding that they have will be less than if they were funded fully as debt, regardless of what interest rate is charged on the debt portion, because the other portion is coming for free. There is no charge to it. So every blended finance client, their blended finance rate, when you normalize it and take into account that they get a grant, ends up being in the single digits. Even though on the loan component, we have added our margin on top of what we get charged. But because the other portion is at zero cost, they are paying lower interests compared to another client that's non-blended finance that is paying 100% loan. So that's just mathematics. One can argue that I got 10 million rands. One is 50 is grant, 50% is grant, 50% is loan. I'm paying the same interest rate on a blended basis as the non-blended finance. It's not the case. If you look at the interest line item that goes into their financial statements, it will be lower than if they were not a blended finance client. And that is one of the benefits that blended finance clients get. Moving on to Honorable Brett's question. Has Land Bank postponed its funding process? I don't think the bank postponed its funding process. So post curing the default, actually before the curing the default, the board had a turnaround strategy that was put together. And this turnaround strategy looked at 5 core areas that must be addressed. The one was the funding model. 2 was a commercial model that speaks to generating sufficient revenue and diversifying revenue. Then there was focus area on the credit model itself to ensure that we improve our NPL ratio, we address the high NPL ratio. There was focus on the organization operational model that speaks to having improved performance across the board, etc. So from the get-go, there was focus on funding. It was one of the core areas that the bank had to look into. We may have forgotten, we may not be aware that after the default, the bank lost a number of critical skills. People don't want to work for a bank that has defaulted, especially those who are very competent. They will find alternative jobs quickly, which is what happened. And so we were left with a huge vacuum that had to be filled up. And so a process to capacitate the bank started since then. So between 2023 and, if you like, towards actually all the way to last year is when we really closed the capacitation gap. There was a lot of focus on capacitation, ensuring that key roles are well capacitated. One of the roles is, of course, treasury, which is the one that drives funding. So there was always a view to ensure that the bank can drive funding as quickly as possible. And some work was started, but it needed someone to drive it. So once we got the current acting EM on board, we started seeing more increased traction on the funding side, because this is her responsibility. She needs to drive it, and she has been doing that. So it was not to say it's being deferred. We needed to capacitate the bank to ensure that we have the right skills that can get us get the job done on time. And the next question is on bad debt situation. How much of the loan book is recoverable? So if you look at the total book currently, before the default, Land Bank's loan book was 45 billion. Currently, it's about 13 billion or somewhere around there. It's reduced because we sold a significant portion of our good book. At that time, the bank also couldn't support clients because of its default state. So some of the clients were assisted by other banks, so they left. And of course, we got paid for the exposures that they had. We used that money to settle our debt. So we have a book of about 13 billion. About 50% of that is non-performing. Again, that 50% is by design, because it's a mathematical outcome. We sold a big portion, which then left a big portion that's well performing, which then left a significant portion that is underperforming. So there's a significant portion of the non-performing book that is a legacy book. That means these loans were originated a long time ago. And now, because they are here and we've reduced our good performing book, they really increase that NPL ratio. When you unpack that 50% non-performing loan book and say, can I see how the loan book looks like since the bank came back to market post-default or just around that time? You clearly see a stark difference in the NPL ratio of what we call new book, which was originated from, say, 2023 up until now. And that NPL ratio, last I checked, was in the region of 10%, versus the old legacy book, which is, over 50%. So that context is very key. If you just look at NPL ratio at a high level, you will not get the insights it gives you, and you will come to the wrong conclusions, especially if you don't take into account the fact that the bank had to sell a good portion of its well-performing book. So it's important for us to keep that context in mind when we talk about NPL. The next question was, and then there's a question of write-off. So we have a write-off criteria that applies. So loans that have not been paying for a long period of time, there's a stipulated time in our policy and they meet certain conditions, and it's very clear fundamentally if there is reasonable assessment that it's impossible to recover the debt, such a loan ends up being written off. And it's standard practice across different banks. Different banks will have write-off policies that they apply. So it's not unique to Land Bank. The fewer resources are available for emerging farmers, I suppose, as a result of the reduction in the book. Is the bank still fulfilling its mandate in respect of development? And this is the crux of the presentation we made, Honorable Brett, to say if the bank is going to truly fulfill its developmental mandate, it needs to be appropriately funded. We have been prioritizing emerging farmers in the recent history. We reset our timeline from default. So when we came back to market, you'll see there's been huge focus on emerging farmer development. Prior to the default, I think the developmental book was in the region of what was it, 13%, 15%. It was not significant. As we speak, the developmental book is about 54%. And I think that also reflects focus on supporting development while balancing financial sustainability. So the bank does need to be appropriately funded to fulfill its developmental mandate. That's really the crux of the presentation I made. Bank will need additional funding to maintain liquidity in 2027. Will taxpayers be called upon to help the bank? And when we speak of helping the bank, we need to contextualize what we mean. Okay. So in this case, the bank is going to debt capital markets to raise funding. And our funders say, we are happy to help you, but we need 1, 2, 3 in place. We need your shareholder to support this fundraising program, and a government guarantee will give us comfort around that area. So then we go to National Treasury and say, this is what our funders are saying. They are happy to give us money, but because the bank is still in a turnaround phase, they would like to get a government guarantee. And as I said, our discussions with Treasury have been positive. We don't have an answer yet. We're waiting for a response, but we've had fruitful discussions. That is necessary to reset and rebase the bank to be financially sustainable. My reference to potential future allocations at different intervals is to support the sector, is to support development. It's not to bail out the bank. We need to separate those two things. So the support of Treasury as we speak now to rebase and reset the sustainability of Land Bank is critical. We got here because of prior arrangements that were not appropriate. Short-term funding supporting long-term funding, which led to a default. And we need to solve that problem now. So at some point, we need to say, let's just solve it. Let's stop pointing fingers. Let's solve it, because it was created by the funding model. And again, I took us back to history on how the bank was funded. We've got the likes of Wendell Slobo and Prof. Creston, who do a lot of research on agriculture. Their views are also in this light. That for development, there will need to be some consideration for regular intervals of capital injection that are meant to support the sector. And then I'll move to the question on the cyber security. So we didn't include details here because the agenda was mainly to update this forum or the committee on our funding business, our funding model, as well as the financial sustainability. But happy to answer the question on the cyber. The bank did not pay any ransom. Yes, the cyber criminal did ask for a ransom. The bank did not pay any ransom. What data was compromised? Some some of our, let me say, our core ERP system and tier 1, tier 2 systems were not affected. So anything to do with core systems, we were able, once we came back on board, to still recover that data. Of course, there was some data that, the cyber perpetrator got access to, and I don't recall the different types of data, but it would relate to various segments across the bank, but it did not affect our core systems, which we rely on to run the business. And it should be noted, based on the feedback we got from our expert advisors on this, who were helping us with the recovery process, that Land Bank is one of the few institutions that was able to recover from the cybersecurity quicker. They referenced, they didn't give us the name, but there was one entity that had this incident last year and to date is still recovering. We were able to recover quickly, largely because of our backup systems that were intact, and of course the hard work of our teams internally working together with our service providers to really get us up and running. And sometimes we underestimate the work that has gone into getting us where we are, and it's important for us to reflect. This is one of the let's call it success stories in terms of recovery, to ensure that we are able to continue doing business. Has any investment been spent on cybersecurity? Yes, as part of the resumption plan, we had to do so post or in line with strengthening security protocols on cyber. So we wouldn't open up certain channels, certain portals or systems until security strengthening had been done. So there was some immediate work that was done to strengthen security. In addition to that, the board approved a short-term plan as part of cybersecurity initiatives that must be implemented to ensure that we build on the strengthening that was done as part of the resumption plan. What is the current value of the NPL book? I think I answered this. Our loan book is in the region of 13 billion. So NPL then will be 50% of that. Let's call it 6 point something. And the NPL ratio is about 50%. But then, as I indicated, you want to then unpack that to get clarity on what it is. The new book is sitting far lower than 50%. It's around 10% or so. What's dragging the NPL ratio is a legacy origination that was done many, many years ago. So that context is important. What contingency exists if the bank cannot raise further funding? I think the obvious one would be to arrange with our LS5 lenders to roll that forward. It's undesirable because it comes with extra costs, and as we indicated, the current arrangement is costly. So we have to make the first prize be the solution, which is raise cheaper funding now. It helps us to rebase, reset soon, and we are well placed to continue supporting the sector. How much lending capacity has been lost since 2020? I would say a lot. And I think this question was coming from the fact that we reduced our loan book from 45 billion to about 13 billion now, and the debt component from 41 billion to just about 6.7 billion now. And which is why the discussion on funding is critical. We need to rebuild that lending capacity so we can continue supporting the sector. Of course, if you look at how we've been doing in the past two to 3 years, the bank has been operating. We've been disbursing funds. We've been seeing growth. So we've been supporting the sector. But we know there's huge demand, and hence the need for us to unlock more funding to support the sector at increased scale than what we are currently doing now. What portion of your current lending reaches emerging farmers? I reference that our current loan book total portfolio reflects 54% of that is to emerging farmers. So hopefully that gives some insight. And of course, with blended finance, we've seen increased focus on supporting emerging farmers. And then I'll move to Honorable Numalo. Does Land Bank have a transformation strategy to take care of black farmers? Yes. I referenced, I think your question was also more on the support that the bank gives. You referenced how to run a business, handle finances, etc. So the Farmers Academy is one avenue that is helping us do that, in addition to the broader partnership program that we have. Transformation is at the core of our mandate. It's not something we can leave to the fringes. So we do that support implementation on this. And then there was a question on land distribution. How will Land Bank assist emerging farmers to have access to land? I think the direct role of Land Bank is when we finance land acquisitions that are productive from a farming perspective. And we've been doing that. I've given an example, but it's not enough because the need is bigger. And hence, this is a much bigger discussion that requires additional stakeholders to contribute. And I referenced land reform before, and this is where that becomes very critical. But from our perspective, we do finance productive land acquisitions, and it's something that we continue to do. In addition to that, is obviously playing a more advocacy role in the broader forums to just reflect on the importance of land moving into the hands of black farmers as part of developing and transforming the sector. What is the target per corporate plan to fund emerging farmers? So for the current year, we have set ourselves, let's say, half of our loan disbursement target is for blended finance beneficiaries. Of course, there are black farmers who, and there may be few, but they are there, who can afford 100% loans. So we still finance those. And those would be part of what we call non-blended finance support. So you can still find a small mixture of farmers that are on the other half that are also black, but they don't qualify for blended finance because of their scale. So we'd finance those as well. And then the last set of questions was from Honorable Chair, I believe, the tenure on the loan book and the debt funding and explaining the mismatch. It's my understanding that you may be looking for figures because some of this was reflected in the presentation. So we may need them to provide amounts if that is the case. But maybe it would be a good place to invite the CFO to see if she can add some input into this, including some of the other questions that I had flagged earlier on. Through you, Chair.
Granted, Mr. Mpambo, but remember on this, especially for this question, I said if possible, that can be submitted in written form. It's not a matter of wanting to respond there and there or now. If there's a need, that can be responded to in writing, but the CFO is welcome to summarize the responses for the questions that she's going to respond to.
Good morning, Honorable Chair and honorable members. our chairperson, and everybody on the call. Chair, with your permission, if I can just align with Mr. Mpambo on the questions that he wants me to respond to. So far, I only have one that I've noted, which is on the interest, as well as the two questions that you've raised, Chair, around the mismatch and the segmentation of the loan book in 10 years. And I am aligned to your guidance that we provide the information in writing. I don't have it readily available with me now. And then on the interest, Chair, so that's the one that I've got. ACEO, were there other questions that you wanted me to respond to?
If you have some input also on the PIC relationship, pension fund, and the transformation fund views, yeah, thanks.
Okay. So I think let me take it from the top then. The issue on the transformation fund, I think it was from Honorable Brett. I don't know if I'm authorized to speak on behalf of the bank on what, because I think the question, sorry, just trying to just get to the right question. Sorry, it was from Honorable Khadebe, my apologies. The attitude of the land bank when it comes to the transformation fund. I don't know if I'm authorized to speak on behalf of the bank on that matter. I think maybe the ACEO is better placed to respond on what the bank's position is as regards the transformation fund. So ACEO, I'll pass this one back to you. I think around the PIC relationship, I thought you covered it well, ACEO, in terms of, I mean, the PIC is one of our funders currently, and there are engagements between Land Bank and the PIC around, alternative ways that, the two can work together. And or the PIC support land bank. So I think those engagements are ongoing. I do believe that I think the relationship is there, and I think it works. But I thought you covered it well, ACEO. On the question around interest, Chair, and I'm going down the list of the questions that I wrote down. Because I think the question was around the bank's profitability and where that comes from. I will provide the interest as the ACEO requested. I do think, though, that is a very loaded and complex question. I think to really answer that question, it will require time for us to unpack the complexities and the challenges, etc., that Land Bank is dealing with, and then how it got to the performance that it got to. I think that was the 2025 number that the honorable member mentioned. I think it's simplistic to just say that, this is the profitability and this is where it came from. It requires a lot of unpacking. In terms of interest, as the ACO required that I provide, apologies for that. The interest income that the bank earned from loans and advances, and this is the gross interest income, was 1.9 billion for 2025, and then the interest from banks, including the just over 700 million that the bank received on the funds that were in escrow, which is the recapitalization amount. The ACO did mention that the funds came with a condition. So even though the allocation was made, or the appropriation was made in, I think, 2022, 2023, the funds actually vested for Land Bank in 2024 after we had concluded the debt restructuring process, which was one of the conditions that came with the recapitalization, and that was the last one. So that we had interest of just over 700 million, but in total interest from banks was 747 million. Thank you, Chair.
Thank you. Is it all from your side, Mr. Mpambo?
Thank you, Chair. Yes, so on the transformation fund, I did share the sort of overall sentiments. My request to the CFO was mainly from, I know some, institutions use this fund for fundraising purposes. So it was coming specifically from a fundraising angle. And I see Priscilla has a hand. She may want to maybe add there. And on the profit ask also, I reflected that it's going to be difficult to split the profit to see where it came from. And hence, my request was that question can be answered by looking at the income split, which is what the CFO has done. Because the profit number now takes, your costs don't care where where they are funded from. So you might struggle to split the profit, across the funding elements. The income stream, sorry. Thank you so much, Chair. I'll pause here.
Ms. Jersey, you are welcome to maybe can respond to whatever question you want to respond to, but kindly summarize and do not exceed the 3 minutes, because usually our meetings takes exactly 3 hours. We started at 9 and we are now beyond 12 o'clock. You're welcome to make your submission or to respond.
Thank you, Honorable Chair. I just want to add on the transformation fund in terms of the question that was posed in terms of our interest also in our posture. So we are in discussions with the NEF, and the bank is interested in participating on the funds of funds. We are still on the stage of investigating how we can add value. And obviously, our focus we want to focus on the agri side of the fund. So we see opportunities in terms of co-funding and also fund management, and also on the due diligence, for the transactions. And helping in terms of the access market and partnership in terms of being an insurance partner. So I just wanted to on a high level add on that transformation fund. But as you know, as the fund of funds, we'll have to apply for allocation and see how we can be further, involved in the fund. So that's where we at now on that stage, but we haven't delved into details with the NEF. That's all I wanted to say. Thank you, Honorable Chair.
Thank you very much for such a comprehensive responses from Team Land Bank. Colleagues, honorable members, Land Bank management, the board, I wish to thank you, especially the delegation from the Land Bank, for the comprehensive induction or information and the update provided to the committee today. This was our first detailed engagement since the debt default of April 2020 was cured in September 2024. And it is really important for this committee that as part of our oversight mandate, we understand the path that the bank has taken and the path ahead. And also as the committee, we will follow up with National Treasury to determine the timelines for decisions on the capital injection and guarantee frameworks, because we believe that as Parliament, we cannot allow a systemically important DFI to face a second liquidation or liquidity event due to delayed executive decisions. It is also our role as committee to assist you as you've come before the committee When Mr. Mpambo opened, they said the information they are giving to the committee is also for the committee to use it wisely to assist them with whatever shortfall they might be having. Let me take this opportunity, colleagues. I'm sorry that we went beyond 12 o'clock, to thank you, honorable members, the support staff of the committee and Team Land Bank for making time and being with us for the most part of the morning. Thank you very much, and we're looking forward to the written responses from your good selves within 14 days. Thank you. This brings us to the end of our meeting. See you again when we meet. I hope it will not take long before the support staff of the committee and the chairperson of the committee, Ms. Ndlovu, calls you again to the committee, because today's information, I think one needs to go back, digest it, and come back for more deliberations, because as I said from the beginning, this was more of an induction to some of us. Thank you very much. Enjoy the rest of your afternoon. Bye.
So
Thank you
please,
so
the chair.
much. Bye.
Long live the chair.